Hi everyone. In this session, we will be seeing how to value an option under a two-period binomial model. Until now, we saw how to value an option under a single-period binomial model where we made two assumptions. The first one being that the share price can only change at the end of the option contract, which in our case, we had assumed an option contract to be equal to 6 months. And we said that the share price of 50 today could change only at the end of the 6th month. So, okay, the share price does not change between today and between the t equal to 6. It exactly changes on the last day of the option contract. The second assumption that we made under the single period binomial model was that the share price can only take two possible values. It could go either up to 55 or it could come down to 45. Okay, these were the two assumptions that we made under the single period binomial. Now, in two-period binomial model, we almost continue with similar assumptions, but the only difference is we break the whole term of the option contract into two exact equal halves. For instance, we had an option contract of 6 months. We will break the 6-month option contract into two halves of 3 months each. Okay, so there will be two periods, and that is the reason it's called as two-period binomial model. The first period is between t equal to 0 and t equal to 3. And the second period is between t equal to 3 and t equal to 6. Okay, if I quickly come to the Excel file where we initially saw the first example, we had an option contract whose maturity is 6 months. The current share price is 50 and the strike price is 48. The 6-month option contract was broken into two halves exactly at the end of the 3rd month. Okay, so we have two periods starting from today and ending at the end of the 3rd month. And the second period is from the beginning of the 4th month to the ending of the 6th month. Okay, so we have broken the 6-month period into two halves. And then we said that the share price can now in single period model, in single period binomial model, we said that the share price can only change at maturity. Here we say that the share price can change at the end of each period within the option contract. Each period meaning the share price can change at the end of the 3rd month, or it can change, and it can change also at the end of 6th month. Okay, so in our example, we assume that the current share price of 50 can go up either to 55 or fall down to 45 at the end of the 3rd month, which is at the end of the first period. Or, you know, let's say if the share price is 55 at the end of the 3rd month, from 55 it can again go up either to 60.5 or it can fall down to 49.5 at the end of 6th month. If the share price at the end of 3rd month is on the downside, which means at 45, from 45 at the end of the 6th month, the share price can go up from 45 to 49.5, or it can fall down from 45 to 40.5. Okay. So the option price, or this should be actually the share price. Apologies, I'll just edit this when I upload it. The share price can only change twice during the contract, once at the middle of the option term and the second time at the end of the maturity of contract. Okay, and at each period the share price can take two values, either an upside value or a downside value. Okay, each period meaning in our example at t equal to 3 and at t equal to 6. Okay, in single period model, what we assumed was that the share price can only change from 50 directly at the end of 6th month, either to 55 or to 45. Whereas in a two period binomial model, I am assuming that the share price can change at the end of each period within the binomial, right? So which means it can change either at t equal to 3, it will change at t equal to 3, and it will also change at t equal to 6. Okay, at t equal to 3, there are two possibilities, and at t equal to 6, although it might look to you that there are only three possibilities, 60.5, 49.5 and 40.5, there are actually four possibilities. Reason being, the share price can go up from 50 to 55 and from 55 to 60.5. That becomes the first possibility. Or the share price can go up from 50 to 55 and from 55 it can actually fall down to 49.5. That is the second possibility. The third possibility is it can go down from 50 to 45 at the end of 3rd month, and from 45 it can increase to 49.5 at the end of 6th month. So if you see, it can be 49.5, but the way to arrive at 49.5, there are two paths. One, from 50 it increases and then reduces, or from 50, it first reduces and then increases. Okay, so within 49.5, there are actually two possibilities. Okay, although the share price is one, there are two ways to arrive at that end. Okay, the means are two. Okay, and the fourth possibility is 40.5, which means the $50 share today falls down to $45 at t equal to 3, and it further falls to 40.5 at t equal to 6. Okay, so at the end of 6-month contract, there are actually 3 possible share prices, but 4 possible paths. Okay, 49.5 is one share price having 2 paths. It can come either up and down or down and then up. Okay. So next, in a 2-period binomial model, we're also going to value American options. Okay, until now, we were actually valuing only European options, whereas now we will also see how to value American options, because American options can actually have slightly different values from European options. Okay, of course, if they had same value as European options, then why would we even classify options into American and European, right? I mean, American options are classified as a separate category because they have a different value from that of European options. Okay, what we are going to do is we will first work on European options, and then we will later adjust the value of European options to arrive at the value of American options. Okay, American options in all likelihood is going to be as part of separate video. In this video, we are only going to look at European options. Okay. Now coming to risk neutral method under the 2-period binomial. Before going that, let me clarify that all the 3 methods that we actually learned, including delta neutral method, portfolio replication, and risk neutral, all 3 of them can actually be used even for the 2-period binomial. Okay, just like how they were used for the single period binomial, they can also be used for a 2-period binomial model. Okay, but risk neutral method is the most common method for valuing options in a 2-period binomial. And I'm talking of this even from an examination viewpoint. Okay, not only from a practical perspective, even from an examination viewpoint, risk neutral method is the most important. Okay, there are no sums where the institute has solved any questions using the other 2 approaches, which is delta hedging and portfolio replication. Okay, so we will be primarily learning risk neutral method of valuation. But I will also show you delta neutral method, because one of the points that I will be showing you under the delta neutral method is going to be very relevant for us to interpret the Black-Scholes-Merton model. Okay, so but I will not be showing you the delta neutral method after the risk neutral method. I will end 2-period binomial once we are done with risk neutral method. And when we step into Black-Scholes method, I will take a deviation over there and explain delta neutral method. Okay. Now coming to risk neutral method, the assumption that we made under the single period binomial continues under the 2-period binomial as well. What is that assumption? The assumption is that the option is being valued by a risk neutral investor. And what is the implication of that assumption? The implication is nothing but the required rate of return, or the discount rate, is now going to be the risk-free rate, which is already known to us. Okay. So this is an assumption, and this implication is continuing from the single period binomial. It continues in the 2-period binomial method. It also continues in the Black-Scholes method as well. Okay, so this assumption and this implication continues right from single period up to Black-Scholes method. Okay. Now what we are actually going to do is, under the risk neutral method, for valuing a 2-period binomial model, we will be looking at the 2-period binomial model as multiple single period binomial models. Okay, what I mean by this is, over here, if you actually see, this is as a whole, this is a 2-period binomial, because the first period is from t equal to 0 to t equal to 3, and the second period is t equal to 3 to t equal to 6. Now I will be viewing them as individual single period binomial models. How am I going to do that? If you look at just what I've highlighted over here, this is nothing but a single period binomial model, because the current share price at t equal to 3 is 55. From 55, it can go up either to 60.5 or it can fall down to 49.5. This is nothing but a single period binomial, right? Where I'm saying that the share price only changes once, where the share price is changing only at t equal to 6, and the share price can only take 2 possible values, either 60.5 or 49.5. So the highlighted portion is one single period binomial. Now if you look at the second highlighted portion, this is again another single period binomial, because at t equal to 3, the current share price is 45, and from 45, the share price can go up either to 49.5 or it can fall down to 40.5. This is nothing but a single period binomial, right? Because the share price is only changing once at the end of the option contract, which is at t equal to 6. And there are only two possible values, one 49.5 and one 40.5. Okay. Now, if you look at the highlighted portion now, this is another single period binomial model where the share price is currently 50. It can go up either to 55 or to 45 at t equal to 3. Okay, so what I've basically done is I have viewed the whole two period binomial model into, I've broken that down into three single period binomial models. Okay, the first one being from this portion where at 55 it can go up either to 60.5 or 49.5, or the second one being the bottom node where the share price can go up from 45 either to 49.5 or it can come down to 40.5. And the third single period binomial model is where the share price at t equal to 0 is 50 and it can move either to 55 or to 45 at t equal to 3. Okay, so we are going to look at the two period binomial model as multiple single period binomial models. Okay, and what we would then do is we would calculate the value of the option at each node. What do we mean by each node? I will be each node basically represents each box in this whole diagram. Okay, so calculating the value of the option at each node means we calculate the option payoff at t equal to 6 at this node, at this node, and at this node. Okay, so we have, this is option payoff, right? Because this is the maturity of the option contract. If you remember, our strike price was 48, which means the payoff of the option at t equal to 6 at this node is 12.5. At this node, it is 1.5. Okay, 1.5 being the difference between 49.5 minus 48 for a call option. And at the upper node, it is 12.5, which is nothing but the difference between 60.5 and 48. Okay, so we are going to calculate the payoff at each node at the maturity of the option contract. Okay, so here we have a payoff of 12.5, 1.5, and 0. And then what we will then do is we will calculate the value of the option at this particular node. Okay, and how we are going to do that is is by assuming this to be a single period binomial. Okay, when we assume this to be a single period binomial model, like how we were doing it earlier, we are going to calculate the value of the option at this node first, and then we will look at this binomial model, this single period binomial model, and then we will calculate the value of the option at this particular node. Okay, and then we have the value of the option at this node, we have the value of the option at this node. What we will then do is we will look at this binomial model and value the option at this particular node. Okay, because we already learned how to value an option using a single period binomial, right? Okay, now all we're doing is we're breaking two period binomial into multiple single periods, and we are going to use the same approach what we used earlier. Okay, so what we would be doing is we would find the value of option at each node in the binomial model, and using the backward induction process is nothing but what we actually did under the risk neutral method earlier. Okay, we were calculating, what we were doing is we had the option payoff at these nodes, and we were we were calculating the value of the option in a backward induction method, right? We were back calculating it, right? So that is called as the backward induction process. We would then calculate the value of the option today. Okay, just to repeat what I said again, we have option payoff at t equal to 6. Okay, what we are going to do is we are first going to concentrate only on this highlighted portion. Okay, this is nothing but a single period binomial. Okay, using the same approach what we did under the single period, we will value the call option at this particular node at t equal to 3. Okay, and then we will forget all the other portion of the two period binomial model. We would only look at the highlighted portion as another single period binomial model, where we will calculate the value of the option at this node. At this node meaning I'm referring to cell D15. Okay, so we will calculate the value of this node. We have already calculated the value at D9. Okay, and then what we would do is we would forget the whole of the graph and concentrate only on this particular single period binomial model, and then we will back calculate Back calculate meaning reverse calculate from the front, right? I mean, that's why it's called as backward induction. We are working to the value of the option today from the values at a future point in time. Okay, so we will then look at this as a single period binomial model, and using the same approach what we followed earlier, we will be valuing the option at t equal to 0. This value of the option is nothing but the premium of the option which the holder has to pay to the writer at t equal to 0. Okay, so value of the option at each node is going to be exactly how we calculated earlier. It is going to be the present value of the expected payoff discounted at the risk-free rate. Okay, so for instance, if we are valuing the upper node, okay, we are not going to look at any other portion of the binomial model. We are going to value the option at D9, with D9 being this cell, as present value of the expected payoff. Expected payoff is either 12.5 or 1.5. And just like what we did in single period, we would be calculating the probability at the upper node, probability of the downside movement. Okay, we will calculate the expected payoff and we will discount that expected payoff using a risk-free rate for 3 months, because we are only bringing the value from t equal to 6 to t equal to 3, right? So our time period over here becomes 3 months, right? So we will be discounting the expected payoff at t equal to 6 to t equal to 3 by discounting it using risk-free rate for a period of 3 months. Okay. Similarly, on the bottom node also, we will be doing the same thing. We will calculate the expected payoff. Expected payoff will lie again somewhere between 0 and 1.5. And we will discount that expected payoff to t equal to 3 by discounting it at risk-free rate for a period of 3 months. Okay, because we are trying to bring a value which is standing at t equal to 6 to the value, I mean, to its value at t equal to 3. We're not bringing t equal to 6 to today's terms. Okay, if we were doing that, then the discount rate would be for 6 months, right? But over here, we are actually bringing the value at t equal to 3 to the end of t equal to, sorry, we are bringing the value at t equal to 6 to the end of t equal to 3. So that's the reason we discount it only for 3 months. Okay, and then when we look at this period, when we look at this binomial model, we have a value of option, we have some value of option at the upper node, we have some value of the option at the bottom node. We will calculate the expected value of the option at t equal to 3, and we will discount this expected value of option at t equal to 3 to today's terms using the risk-free rate for a period of 3 months again. Okay, because the expected value of option is actually standing at t equal to 3 now, right? So what we need to use is just discount rate for a period of 3 months only. Okay, so we are going to then calculate the value of the option today. Okay, so just like how we exactly did under the single period, we are going to calculate the value of option at each node as the present value of expected payoff discounted at the required rate of return. Okay, just like what we saw earlier, to calculate the expected payoff, we need the risk neutral probability of the share price going up and the risk neutral probability of the share price going down. Okay, and we are going to calculate the probability using the formula that we actually derived under the single period. The formula is going to be probability of up move. P always denotes the probability of up move is equal to R minus D divided by U minus D. Okay, we have already learned what U and D mean. Okay, I will just be making one small change to it. But before that, I will first tell you what R is. Okay, R, like we saw earlier, is the periodic interest rate factor. Okay, in the example that we actually saw earlier, in the single period method, we had taken a risk-free discount rate of 5% per annum compounded semi-annually. Okay, so what I first did was, since the option contract was a 6-month contract, what I basically did is I multiplied 5 with 6 by 12. Okay, so 5 into 6 by 12 is 2.5%. Okay, so 2.5% for 6 months. And then I just added 1 to it. Okay, because I needed the interest rate factor, I added 1 plus 2.5%, which is equal to 1.025. Okay, so my R over here was 1.025. Over here meaning in the single period method. Okay, so whenever we were calculating the probability under the single period binomial, where we had to use R, we used 1.025. Okay, just to again mention it, it was 5% per annum compounded semi-annually. we've divided 5, we basically divided 5 by 2 because it was we needed it for a 6-month period. So our risk-free rate was 2.5% per annum, and I needed the interest rate factor, right? So interest rate factor was nothing but 1.025. Okay, but in a 2-period binomial model, although the maturity of the option contract is 6 months, I am looking at each individual 3-month period. Okay, so over here, when I'm actually looking at the time, I should be taking time as 3 by 12. Okay, so the periodic over here would not mean the term of the option contract. It is not 6 months. It is the term of each period within the binomial tree, which is nothing but 3 months. Okay, so if I had to do the same thing in 2-period binomial model, what I would first do is I would multiply 5% with 3 by 12. Okay, multiplying it with 3 by 12 or divide 5% by 4. Okay, and then I would get maybe 1.25 percentage. So is it 1.25? Yeah, it will be 1.25 percentage. Okay, so it will 5% per annum compounded over here. It won't be compounded semi-annually. It will be 5% per annum compounded quarterly, will be equal to 1.25% for each quarter. Okay, each quarter, because my period for a single binomial is actually 3 months. Okay, although the term of the option contract is 6 months, I am looking at it as multiple single period binomial model where each period is for 3 months. Okay, so everywhere wherever I have to use into t, my t becomes 3 by 12 and not 6 by 12. Okay, like where even if I'm discounting any value to today, like we saw earlier, I had to discount the value at t equal to 6 to value at t equal to 3. Okay, over here my term or the discounting rate I should be using is for 3 months, right? Not for 6 months. Similarly, everywhere wherever I have to use r, okay, I have to multiply that with t obviously, but the t here becomes a single period, which is 3 by 12 in our case. Okay, so for instance, if the maturity of the option contract is 6 months, a 2-period binomial model will be splitting the 6 months into 2 equal halves of 3 months each. Okay, therefore for our purpose, t is equal to 3. Okay, okay, even if you've not really understood, I think it's fine. We will be taking an example where it will be very clear. Okay, there is no change to u and d. Okay, they continue to be the same up move and the down move factors, but within the formula of u, if you remember, the formula of u was e power sigma root t. Okay, over here also t is no longer 6 by 12, it becomes 3 by 12, because now we are seeing how much can a share price go up or down in a period of 3 months, not 6 months. Okay, because at standing at t equal to 0, I want to see how much can a share price go up or down by the end of the 3rd month. Okay, and then I will again stand at t equal to 3. Okay, so for instance, over here I'm standing at 50. I want to see how much can the share price go up or down at the end of t equal to 3. Okay, so the formula that I need to use is e power sigma into square root of 3 by 12. Okay, where t is equal to 3 by 12. Okay, then what I do is I stand at 55 and again I look as to how much can the share price go up or how much can the share price go down in the next 3 months. Okay, so again my t over here becomes 3 by 12 or 0.25 years. Okay, so even within u and d, the calculation is impacted. Okay, the only impact is going to be that the term is now going to be 3 by 12, which is each period's term instead of 6 by 12. Okay, I will be mentioning, just to make that clear, I will also add a point that within u and d also there will be a change in the t that we use. It won't be the maturity of the option contract. It will basically be each period within the within the binomial model. Okay, next is I will actually not be using discrete compounding. I will actually be using continuous compounding from here on. The reason is the facts that I'm going to take as an example for 2-period binomial, I would like to continue that even for Black-Scholes model. I would be using the same set of facts even in the Black-Scholes model so that I can actually show you a comparison between the 2-period binomial model and the Black-Scholes model. Okay, so Black-Scholes assumes continuous compounding, and even within the 2-period binomial, I will now have to use continuous compounding. Okay, so the knowledge of continuous compounding is prerequisite. I have unfortunately not taken any lecture so far for showing you how compounding is done in continuous terms. So what I would be doing is I would be giving you the description of one of the YouTube lectures which is available. It was taken by Rahul Malkan sir. It shows you how compounding is done on a discrete basis, and then he also shows you how it is done on a continuous basis. I will be giving you that description as part of the below video. Okay. After this, hopefully I will be moving into bond valuation, and when I discuss about interest rates then, and if I do upload a video lecture on continuous compounding, I will also edit this video to include my lecture as well. Okay, so you will have, if you're watching it later on, you will have an option to see my lecture or Rahul Malkan sir's lecture. I will leave it to you. Okay, so but prerequisite is knowledge of continuous compounding is required. If you do not know, my recommendation is probably take a pause and go and watch the other lecture. I think that's of about 20 minutes. Okay, so you go and watch that lecture. Even if you are okay with proceeding, all you have to know is how to calculate e power something. Okay, e power x, if I give you, you should know how to calculate. It's not going to be a problem for CFA and FRM students because they have a calculator which calculates e power x. Okay, it's going to be a problem for CA final students where we generally use table values. I will be showing it to you on Excel as well. Okay, how we calculate e power x, I will be showing it to you on Excel as well. Okay, but knowledge of continuous compounding from here on is actually required. Okay, let's take an example now finally, and I will be using the same facts for Black-Scholes model also. Okay, and that is the reason actually, although I had an example over here that we took initially where 50 was going to up to 55 or 45 and then further at t equal to 6, I don't want to use this example. I will give this to you as practice. I will share the answer with you also. Okay, but I don't want to go ahead with this example. I don't want to go ahead and solve this example because I cannot use this example for explaining Black-Scholes. Okay, and that is the reason I want to take fresh set of facts. Okay, and I'm using these facts for myself. Okay, so the question is, calculate the value of call under the 2-period binomial if the stock price is 170, the stock price today is 170, the strike price is 160, which means the stock is already in the money. Okay, because the strike price is 160. I'm talking again of call option. The strike price is 160, the stock price is 170. So therefore the call option is already in the money by $10. Okay, the risk-free rate is 7% per annum compounded continuously. Okay, I've intentionally changed the risk-free rate because we've been doing 5% right since the beginning. I got vexed up with it. Then the volatility or the standard deviation is 18% per annum compounded continuously. Okay, this volatility is nothing but volatility of the returns of the underlying stock. Okay, it is exactly calculated just as how you calculate normal volatility or standard deviation. It is summation x minus x bar the whole square divided by n or n minus 1 as the case may be. Okay, CA final students, you probably would be using summation x minus x bar the whole square divided by n. CFA and FRM might be dividing it by n minus 1. Okay, this is volatility of nothing but the standard deviation of the underlying shares returns. Okay, so you calculate the return of the share and then you calculate the standard deviation of those returns, and expressed on a per annum basis it is 18%. Okay, and the time to maturity of the option is 6 months. Okay, now we have to calculate the value of this option using a 2-period binomial model. Okay, so let me first come. I've plotted the same set of facts over here. The strike price is 160. The spot price is 170. Don't get irritated by the fact that, okay, I will actually delete these. Okay, the spot price is 170. Risk-free rate is 7% per annum. Standard deviation is 18% per annum, both compounded continuously. Time to maturity of option is 6 months. Okay, under a 2-period binomial model, if the option maturity is for 6 months, we are going to break that 6 months into 2 halves of 3 months each. Okay, so each time step is going to be 3 months. Okay, so we are going to have one share price movement at the end of t equal to 3, and we are going to have the second share price movement at the end of t equal to 6. Okay, and if you have noticed, I have not given you what the share prices will be at t equal to 3 and t equal to 6. Okay, because the reason is I want to calculate that. how am I going to calculate? If you remember, we calculated U and D. Okay, we calculated the values of U and D in the previous lecture or lecture earlier, whatever. Okay, the name of the lecture was Understanding U and D, if I'm not wrong. Okay, and then we saw that the share price at the upper node is going to be the current share price multiplied by U, and the share price at the bottom node is going to be the current share price multiplied by D. Okay, so that is how we are going to arrive at the value of U and D at each particular node. Similarly, at t equal to 3 also, okay, when we have to estimate the share prices at t equal to 6 as well, right? So at t equal to 3, we will be looking at this single period binomial. We will say that the current share price is some amount that we are going to find. And then from here, the share price can go up or go down. So when we will multiply it by U to arrive at the upper share price, and we will multiply it by D to arrive at the bottom share price. Even if you have not understood, that's fine, because we will be doing it now. Okay. So although I have an Excel sheet, I will be doing it parallelly in Excel as well as in a notepad. Okay, so please have your pens and calculators ready. Okay. Okay, so first we'll start off with calculating the value of U. Okay, so if you remember, wow, U, okay, fine. So if you remember, the formula for U was U is equal to e power sigma square root of t. Okay, and over here, t is actually not 6 months. Okay, that is, or what I was trying to say, t should be equal to each time step. Okay, so t is actually equal to 3 months or 0.25 years, right? 3 months is nothing but 0.25 years, 3 divided by 12. Okay, so u is equal to e power sigma root t, which means u is equal to e power sigma was 0.18 into square root of 0.25. Okay, so I'm calculating 0.25 square root is 0.5 multiplied by 0.18, which is equal to 0.09. Okay, so that is equal to e power 0.09. E power 0.09 is 1.0942. Okay, I'm taking up to 4 decimals. Okay, so u is actually equal to 1.0942, and d can be calculated as 1 by u. Okay, I'm not applying, or basically what you have to do is e power minus 0.18 into square root of 0.25. That is the original formula of u, but I'm basically doing, or I think actually we should be doing that, because over here we will be having some rounding errors. Okay, so let us actually go ahead with using the original formula itself. It is e power minus 0.18 into square root of 0.25, which is equal to 0.9139. Okay, the reason why I didn't do 1 by u is because when you divide 1 divided by 1.0942, this is already a rounded number, right? So there would again be a rounding difference, which I didn't want to really have. Okay, so that is the reason I did not use 1 by u as a formula. I've used e power minus 0.18 into square root of 0.25. Okay, so u, and we have calculated the values of u and d. Okay, let us quickly do that in Excel as well. Okay, it will be a good value addition. Trust me on that. Okay, so u is equal to, the formula for finding out e power something is, in Excel you have to use exp. Okay, this is exponential. Okay, so exponential, and in brackets you have to write the number. Okay, the number for us was 18%. I don't have to write again 18 and percentage. It's already 18%, which means it's 0.18 into square root of, square root is calculated using sqrt. Okay, square root of 3 by 12. Okay, so I need 3 by 12. All right, I didn't basically close the bracket. There was no error. 1.094, which is what we got as well. Okay, so let me just increase the decimal to one additional, this one, 1.0942. Okay, over here again, okay, over here I'm just doing what this divided, I'm doing d is equal to 1 by u, which is nothing but 0.9139, and that is the same as what we got over here. Okay, Excel does not have that problem of rounding because it is showing us 4 digits, whereas in reality it has further digits ahead of it also. Okay, so when I do 1 by u, there's going to be no issue of rounding. Okay. Next, I'm calculating P. Not P, sorry, R. Sorry, because the formula for P to find out the upside probability is R minus D divided by U minus D. Okay, now we have calculated D, we have calculated U. The only thing that we need to calculate is R. Okay, risk-free rate is given as 7% per annum, compounded continuously again. Okay, so which means my R is actually, if this was not risk-free rate, hypothetically, if this was, I mean, if this was not, um, uh, give me a second, guys. Okay, if this was not continuously compounded, okay, and if this was compounded on a quarterly basis, what we would have done was we would have done 7 into 3 divided by 12, okay, which would have been 7 by 4. It would have been 1.75 percentage. Okay, that is going to be the risk-free rate for 3 months. And then our R over here, this R would have been 1 plus 1.75 percentage. Okay, which is equal to 1.0175. Okay, this is how we would have calculated had it not been done on a continuously compounded basis. Okay, but over here, our question is on a continuously compounded basis, which means 7% per annum is to be expressed as e power RT. Okay, where e power RT is e power 0.07 into t is not 6 by 12, it is going to be 3 by 12. Okay, because this is for a period of 3 months. Okay, so e power 0.07 into 3 divided by 12. So then it is going to be e power 0.0175. Okay, if you actually see, it is the same 1.75 percentage is what we were getting, but we are doing exponential of that. Okay, so e power 0.0175 is nothing but 1.0177. Okay, again I'm rounding this off. Okay, it is 1.0177. If you actually see, there is only the difference between compounded on a quarterly basis and compounded continuously is only in the last decimal. Okay, the other remaining portion is actually the same. Okay, that's the only change, because when you're compounding continuously, your 1 rupee today grows at an increasing rate. Okay, and that increase, an additional increase, is basically that decimal at the last at the fourth decimal. Okay, so that is the only change, but we have to use this number. Okay, although it is very small, although the difference is very small, we will have to use this 1.0177. Okay, so R is equal to e power RT is equal to 1.0177. Okay, now let us calculate P. P is nothing but R minus D divided by U minus D. Okay, which is nothing but 1.0177 minus D was 0.9139. That divided by U minus D, where U was 1.0942. This is equal to 1.0177 minus 0.9139 is 0.1038, 0.1038, the whole divided by 1.0942 minus 0.9139 is equal to 0.1803. Okay, which is equal to 0.5757. That is equal to 57.57 percentage is the probability. This is the risk neutral probability. If you remember, this is the risk neutral probability. This is the probability that would have been assigned by a risk neutral investor, given that he needs his required rate of return is 7% per annum, compounded continuously. Okay, this is the probability that he has assigned for the up move. Okay, P always is denoted for up move. Up move probability. Okay, now let us actually come back to the Excel and solve. We have calculated R, where R is equal to e power RT, okay, because we are using continuously compounded rates. So R is equal to e power exponential RT, where R is equal to risk-free rate into 3 divided by 12, okay. So here again, T is actually each time step, and it does not represent the maturity of the option contract, okay. Then we have to calculate probability. Probability is nothing but R minus D divided by U minus D, okay. So what we are going to do is this minus D divided by U minus D, okay. Please in Excel remember the BODMAS rule that you have to use, okay, because division happens first and then it's followed by subtraction, right? Okay, so that's the reason you have to actually put brackets over here, otherwise the answer will be completely haywire, okay. So the probability that we actually got was 0.5757, whereas what the Excel is showing is 0.5755. Reason being, we have actually rounded all these figures. Okay, I mean, the Excel is showing only 4 decimals, but it is not rounding it off to 4 decimals. Okay, it has got further values. You know, for instance, if I keep showing you, it has values beyond 4 decimals as well. So that's the reason we are actually I mean, the probability that we have over here is not exactly matching with what we got in the paper, okay? And then 1 minus P, which is the probability of down move, is going to be 1 minus this, okay? So this is 0.4245. In our case, I'm actually getting pissed off now with this video, because in Excel I have to move it to the right, in Notepad I have to move it to the left. Okay, fine. Okay, so and 1 minus P is basically 0.4243. Okay, I'm just thinking if we need to can we continue with the Excel probabilities, because I think that will be better, right? I mean, although in examination, yes, these probabilities are going to be fine. Let me just throw this video to some end. 1 second. Yeah, I think this is the best place. Yeah. Okay, in the Excel, maybe like, you know, in the exam you can actually continue with these numbers, but since we have different set of numbers in Excel, I would like to take the Excel numbers because these are more accurate, right? Okay, so we are going to take P as, finally we will be taking P as 57.55 percentage and 1 minus P as 42.45 percentage. Okay, these are going to be the final set of numbers. Hardly any change, it's just the last decimal which has changed. Okay, but for the convenience, I think I had to basically take this. Okay, so these are our final numbers. Apologies for the confusion. I don't think there should be any confusion, but fine still. Okay, so our probability of up move is 0.5755, probability of down move is 0.4245. Okay, if you see, the moment I actually plotted U and D, these values automatically turned up. Okay, now, but even before, let's calculate those values from by ourselves. Okay, so we have a current share price of 170, which can go up, and the upside price will be 170 into U. It is the spot price into U, okay, where U is nothing but 170 into 1.0942. Okay, that is equal to 170 into 1.0942, which is equal to 186.01 or 02, whatever. Okay, and from here 170 could also fall down, and this value will be S into D, which is equal to 170 into, what was the D in our case? 0.9139. So 170 into 0.9139 is 155.36. Okay, so from 170, what we have basically said is it can either go up by 1.0942, where 9.42% is the return. Okay, it can go up to 186, or it can fall down by about fall down to 155.36. Okay, this is at t equal to 3 in a span of 3 months. Okay, again from here the share price can either increase or it can decrease. Okay, and again from the bottom node at t equal to 3, the share price can increase or the share price can decrease. Okay, and this is actually going to give you one common value, because we have taken values such a way that d is equal to 1 by u. Had we not assumed that d equal to 1 by u, okay, and if we would not have assumed that, heavens were not going to fall. I've been telling this again and again. The only difference would have been, we would have, instead of one share price over here, we would actually have two share prices. Okay, they're now going to converge into a single share price, because d and u are actually d is actually the inverse of u. Okay, so this node is actually going to be s into u again. Okay, this is nothing but the, sorry, what was that? U. This part is actually nothing but what you got at the upper node at t equal to 3. Okay, so the first part of it, one is nothing but 186.01, and you are going to multiply 186.01 again by u, which is 1.0942, to get 203.53. Okay, and then let us go first to the bottom node. This is going to be s into d again. Okay, s into d is nothing but 155.36, which you got over here. And then we are again pushing this share price further downside by multiplying it by 0.9139. Okay, that is equal to 155.36 into 0.9139 is equal to 141.98. Okay, now coming to the middle node, this can be calculated either as S into U into D, which means the share price goes from 170 to 186. That is S into U, and then it falls down, and therefore we are multiplying it by D. Or an alternate way would be S into D into U, which means the share price is first falling. It's falling from 170 to 155.36 at t equal to 3. And from 155.36, it is increasing to this part at t equal to 6. Okay, and this should be exactly equal to 170. If you actually see, if you multiply 186.01 with 0.9139, it is giving you 169.9945, which I've rounded it off to 170. Okay. Don't be surprised when you actually see that 170 is the price at t equal to 6. By the way, this is at t equal to 6. Let me make it clear. Okay. Don't be surprised that this 170 is actually equal to the current spot price. The reason it is because S into U into D, where D is actually nothing but 1 by U, right? Sorry. So S into U into D is nothing but 1 by U. So obviously 1 by U and U get cancelled to give you finally S, which is nothing but the current share price, right? So don't be surprised. It has to be 170 logically. Okay. The only place when it will not be 170 is when you do not assume D to be equal to 1 by U. For instance, if you remember in the very initial two-period binomial that we took, over here I did not assume D to be equal to 1 by U. U was 1.1, D was 0.9, D was not equal to 1 by U, and that is the reason I got 49.5 over here, which was not equal to 50, which is the current share price. Okay. Otherwise, in all other cases, wherever that D is equal to 1 by U holds good, it has to be, I mean, the middle node has to be equal to the current share price. Okay. So we found out the share prices as well. Let us quickly match these share prices with what we have in the Excel file. It is 186.01, 155.37, 186.01, 155.37, 203.53, 170 in the middle, and 142 at the bottom node, 141.98. Perfect. Okay. So this is our, let me redraw the binomial model neatly without the formula, etc. So we have 170, which could go up or which could fall. It could go up to 186.01, or it could fall down to 155.36. This could further go up to 203.53, or it could fall down to 170. All right. And this could go up to 170 and it could fall down to 141.98. Okay. Now think of a call option whose strike price is 160. Let's calculate the payoff of the call option. Remember, this is t equal to 3 and this is t equal to 6. Let us calculate the payoff of the call option at t equal to 6, okay, which is nothing but the maturity of the option contract, right? So at t equal to 6, at this position, if the share price is 203.53, the option gets exercised because its strike price is 160. The payoff is going to be 43.53, okay? At this node, again, the option is going to get exercised because the share price of 170 is greater than the strike price of 160 and the payoff will be 10. And at this node, the payoff is going to be nil because the option does not get exercised. Okay, so we have three possible payoffs, one 43.53, the other is 10, third is 0. But remember, this 10 again has two paths, just like how this 170 has two paths, meaning it can go either up and then down, or 170 can come down and then go up to reach this final destination. Similarly, 10 also has two possible paths, right? It can go either up and then arrive at this situation to give 10, or the share price can come down first, then go up to give a payoff of 10 at the final maturity of the option contract, right? So 10 also has two possible paths, okay? We found out that the probability of each up move is actually equal to 57.55 percentage. Okay, so this is 57.55 percentage. And remember that 57.55 percentage is the probability of all the up moves. There are three up moves if you see. One is this, the second is this. So the probability of this up move is also 57.55 percentage. The probability of 155 going up to 170 is also 57.55 percentage. Okay, that P over there denotes the risk neutral probability for all the up moves in the whole binomial tree. Okay, now the bottom, the down move probability is 42.45. Okay, so 170 coming down to 155 is 42.45 percentage. 186 coming down to 170 is also 42.45 percentage. And finally, 155 falling to 141 is also 42.45 percentage. Okay, so the probability of all the up moves is 57.55. The probability of all the down moves is 42.45 percentage. Okay, now we have the probabilities, we have the payoff. All we need to do is find the expected payoff at each node. Okay, so first we will calculate the expected payoff at t equal to 6. Okay, by multiplying 43.53 with 57.55 percentage and 10 with 42.45 percentage. So we will have an expected payoff which will lie between 10 and 43.53. We will discount this expected payoff by 3 months. Okay, we will find the expected payoff at this node. Okay, so what we are actually going to do is, if I basically give me a second. First, what I would require you to do is just concentrate on this particular option values or the share values. Okay, do not look at any other binomial model. Okay, so when we are calculating the expected payoff, this expected payoff is at t equal to 6. Okay, we are calculating the present value of the expected payoff and we are calculating the present value at t equal to 3. And therefore, you need to discount the expected payoff just by 3 months. Okay, so your risk-free rate is 7%, and that should be multiplied by 3 by 12 and not by 6 by 12. The maturity of the option contract of 6 months is not relevant. Okay, so please look at only the highlighted portion. All right. So value of the call, I'm denoting this as, okay, I mean, I'm calculating the value of call at t equal to 3 when S equals 186.01. Okay, this is making it clear that I'm trying to calculate the value of call at t equal to 3. Okay, I have a payoff that could be either 43.53 or 10. The probability that the payoff will be 43.53 is 57%, and the probability that the payoff will be 10 is 42%, right? So I will calculate the expected payoff and I will discount that expected payoff for 3 months. Okay, so the expected payoff is 43.53 into 57.55% plus 10 into 42.45%. And remember, this is the expected payoff at t equal to 6. This is at t equal to 6. We are required to discount this, whatever we get, to today's terms. Okay, so first let us find out the expected payoff. Let us find out the value of this. Okay, expected payoff is equal to 43.53 into 57.55% plus 10 into 42.45%. It equals 29.29, 29.30. Okay, this is again at t equal to 6, right? Therefore, value of call at t equal to 3 is going to be 29.30, the whole divided by e power rt. Okay, which is going to be equal to 29.30 divided by e power 0.07 into 3 by 12. Okay, remember, this is the most important thing, this part. Okay, it should not be 6 by 12, it's 3 by 12. Okay, so 0.07 into 3 divided by 12, exponential is 1.101765. That is equal to 29.30 divided by 1.0177. Okay, this is nothing but what we actually calculated earlier also as R over here. It's the same value. Okay, so 29.3 divided by 1.0177 is 28.79. Okay, so the value of call option at t equal to 3 when share price is 180, what? When the share price is 186.01, the value of the call option is 28.79. Okay, which means at t equal to 3, if the share price is 186, the value of the call option is going to be 28.79. Okay, I'll repeat, at t equal to 3, if the share price is 186.01, the value of the call option will be 28.79. And the same way, we will be calculating the value of the option at the bottom node. Okay. When S at t equal to 3 is 155, is it? 155.36. Okay, this is situation 2 basically, right? The above one was situation 1. Okay, the expected payoff at t equal to 6 is going to be 10, because that was the payoff at t equal to 6. The payoff at t equal to 6 could either be 10 or it could be 0. I am multiplying that with the probability of 57.55% and 42.45% respectively. Okay, so the expected payoff this time is going to lie between 0 and 10 somewhere. Okay, So 10 into 57.55 percentage plus 0 into some 42.45 percentage. The whole term is actually going to be 0 itself, right? So this is nothing but 5.755, 5.76 rather, okay? So the expected payoff at t equal to 6 is 5.76. Therefore, the value of call option at t equal to 3 is going to be the present value of the expected payoff, which is nothing but 5.76, the whole divided by e power rt, which is 5.76, the whole divided by 1.0177. The same thing as what 1.0 denominator is the same thing, right? 1.0177. 5.76 divided by 1.0177 is 5.66. Okay, so now if you actually look at it, in the second, when we were calculating the value of the option at this particular node, what we did was we basically just looked at this part of the binomial tree. It's going to get messier. I'll just remove it. Okay, but we were basically looking at this part of the binomial tree, the bottom side. Okay, or if I show it to you in the Excel, we were concentrating on this part of the binomial tree. Okay. Now what we are going to do is we will be concentrating on this highlighted portion of the binomial tree. We will be ignoring the rest of it. We have a value of call option at this point. We have a value of call option at this point. We are going to find out the value of the call option today. Okay, how? The same way as what we did earlier. Okay, so if you look at it, let me first plot the, okay, yeah, fine, let's go ahead. Okay, now this is at t equal to 0. I mean, this is the calculation at t equal to 0. Okay, so first I will be calculating the expected payoff at t equal to 3. Okay, the expected payoff at t equal to 3 is going to be, see, the probability that the share price can go up from 170 to 186 is 57.55, and the probability that the share price can fall from 170 to 155 is 42.45 percentage. Okay, the value of the call option at t equal to 3 on the upside is nothing but 28.79, and the value of the call option at t equal to 3 on the bottom end is 5.66. Okay, which means that there is a 42% chance that the value of the call option will be 5.66, and there is a 58% chance, what was it, 58, right? Yeah, 58% chance that the value of the call option is going to be 28.79. Okay, so the expected payoff is nothing but 28.79 into 57.55 percentage plus 5.66 into 42.45 percentage. Okay, and this is going to be equal that's equal to 18.97. Okay, this is equal to 18.97. 18.97 is the expected payoff of a call option, or the expected value of a call option at t equal to 3. I need the value of the call option at t equal to 0, right? This is what I need. Okay, let me over here, let me not call it the payoff. Let me actually call it the value of the call option, because payoff is at maturity, right? Payoff is generally at maturity. At t equal to 3 is not maturity. T equal to 3 is the end of one of the periods. It's not the maturity of the option contract. Okay, so I'm calling it the value of the call option. The value of the call option at t equal to 0 is going to be 18.97, the whole divided by e power rt, which is equal to 18.97, the whole divided by 1.0177. 18.97 divided by 1.0177 is nothing but 18.64. Okay, 18.64 is the value of a call option whose current spot price is 170, whose strike price is 160, whose standard deviation per annum is what, 18% per annum, okay, on a continuously compounded, and where the risk-free rate is 7% and the option maturity is 6 months, where we divided the whole 6-month period into 2 halves of 3 months. Okay, so the value of the call option today is 18.64. Okay, what we did was, first we concentrated on this binomial. We calculated the value of the call option at this particular node. Okay, the payoff we already calculated because the payoff is very easy to calculate. We calculated the value of the call option at this node as the present value of the future expected payoff. Okay, then we concentrated on this binomial part, and then we calculated the value of the call option at this node as again the present value of the future expected payoff, where the expected payoff this time was between 0 and 10. Okay, it was about 5 point something. Now we are concentrating on this binomial, and we are looking at the value of the call option at t equal to 3. We know these two values. So we then find out the expected value of a call option, which is going to lie between these two values. And we discount that for again 3 months to find out the value of the call option today. Okay, and that what we found out was 18.64. Okay, if I just quickly show you on the Excel, the payoff that we had was 43.53, 10 and 0. I found out the value of the call option using the same formula, the probability multiplied by upside payoff plus downside probability multiplied by downside payoff, the whole divided by R. R is e power RT. Similarly, I found out the value at the bottom node, and then I found out the value of the call option today. Okay, so this is how we calculate the value of a call option under 2-period binomial. So what we essentially do is we look at the 2-period binomial as multiple single-period binomial at each node. So at the maturity of the option contract, we first plot the payoff. Okay, what will be the value that the holder of an option will receive if the call option gets exercised? We calculate the payoff, and then by backward induction process, we calculate the value of the call option at each node by looking at the individual or single period binomial. Okay, so we had 3 single period binomials within this 2-period binomial. So we calculated the value of the option at t equal to 3. Remember, this is the value of the option. Okay, this is not the payoff of the option because payoff is only at maturity. Okay, so this is the value of the option. Then we calculated the expected value of the call option at t equal to 3. We then discounted that expected value to today's terms using the risk-free rate. Okay, so there are 2 additional things that we actually learned in this question. We for the first time actually calculated U and D because the share prices were not given to us, and then we also saw how to deal with a 2-period binomial. The most important thing according to me is everywhere wherever you use T. For instance, in the formula of U, you have to multiply standard deviation with square root of T. Over there, T is not the maturity of option contract. It is the period of one single period binomial, okay, which in this case is 3, okay. It is basically each time step in the multi-period binomial, all right. Similarly, even for calculating R, we actually used e power RT, where e raised to the power RT, the T was 3 by 12 and not 6 by 12. Okay, so I think this is the most important thing where you need to consider T to be each time step and not the whole option contract. Okay, so I think that's it for now. That's it for this session. I think it's been a fairly long one. In the next one, we'll go to valuation of a put option and American option. Okay, thank you guys.